Get over to Jim Bianco, founder and president of Bianco Research, and we've had some interesting calls on over the last 7 hours of programming that I've anchored this morning, Jim. A couple of them being 150, 200 basis points on the 10-year, and I wanted to get your take on that, considering a look that you've had at raw materials prices rising.
Yeah, thanks for having me, Matt. Interest rates rising is neither good nor bad. It depends on why they're rising. Typically, they rise because nominal growth is going up. Okay, nominal is real plus inflation. If they're going to go to 150 to 2% because we're going to have booming real growth, that's actually a good thing, and it'd probably turn out to be a good year for the stock market. But if they're going to go to 150 or 2% because we're going to have a resurgence of inflation, and that will be problematic for risk assets like the stock market. You mentioned raw material prices. Those are the commodities that don't trade on futures, that don't have the speculative interest. They're going ballistic right now. They're up 25% in the last 8 months, and the chart looks nearly vertical over the last few months as they've been heading higher. And that, to me, suggests that maybe we're going to see a real resurgence of inflation. So that 150 forecast on the 10-year would actually turn out to be a problem as opposed to a benefit if it was just real growth.
Yeah, either you tweeted that out. I talked, my producer, Veronica Graff, maybe she tweeted out this raw materials graphic showing copper, lead, this is the scrap, steel, zinc, tin, burlap, cotton, just all shooting up over a recent period. What's driving that? Is that because, you know, I wouldn't expect these prices to jump higher. This is not a market that's full of speculators at a time when, you know, the Western world is shut down due to COVID.
I think two things are driving it higher. First of all, for lack of a better phrase, the factory of the world, China, is pretty much back online and demanding a lot of this stuff as raw material for the products that they produce. And so they're sucking it all up as well, too. And there is an anticipation that the economy is going to recover in the second half of 21 once we get vast adoption of the vaccines. So a lot of people are anticipating that we're going to need more product, we're going to need more stuff as we start to recover and people want to get out of their house and start resuming their life again.
So is this, you know, nominal growth that's going to come expected to be coupled with inflation in order to equal these gains in rates? Is that going to show us an overheated economy by the end of next year?
That's the risk. I mean, you know, when I talk about nominal growth going up, for the last 25 years, it's always been real growth. And so we use those terms interchangeably because for the last quarter century, we didn't need to delineate the two. But if it turns out to be inflation that is going to percolate, and let me quickly mention, 2.5, 2.75 core inflation is all you need in this environment to say that you have inflation. That could also lead to fears that the economy is overheating, inflation is returning. Maybe the central banks are going to have to step up. I know when it starts, the central banks will dismiss it as transitory. They always do. But at some point, when you've got this much stimulus coming in with all the checks, the promise of more checks, the promise of more stimulus under the Biden administration, and a vaccine to restart the economy, that burst could finally produce something we haven't seen in a quarter century, and that is inflation.
Okay, so the last time I'm filling in this week for my good friend John Farrow, and the last time I was on this program with John and Tom, I think we were talking about, you know, the ECB on hold until 2023, the Fed on hold out until 2024. But if we start to get that inflation, Jim, at 2% or 2% and change, how do central banks then shift into neutral and start to put it into drive by the end of 2021?
Well, think back to the fourth quarter of 2018. The central banks were at that point going to promise that they were going to reduce the balance sheet. It was going to be an automatic pilot. It was going to be like watching paint dry. The markets threw a fit. They didn't like it. And within 2 weeks, they scrapped the whole plan and they went in a different way. The central banks today are on hold till 2023, 2024, until the markets decide that they're not on hold. Once the markets have ferreted out inflation and they think that it's coming back, they'll demand the central banks will act. The central banks will fight it for about 2 weeks, and then they'll pivot and they'll start moving in the direction that the markets want, just like they did in the fourth quarter of 2018.
All right, Jim, thanks so much for joining us. Appreciate getting some time with you. Jim Bianco, founder and CEO of Bianco Research.